Before we get started, we'd like to get your input on a couple of polling questions. The first polling question should be showing on the screen for you now. And that question is, which of the following real estate related assets are you most interested in learning about? And you're welcome to select as many answers that apply. Your answer choices to choose from are REITs, mortgage backed securities, private real estate equity funds, private real estate debt funds, physical real estate holdings, infrastructure or energy funds, or none of the above. Again, the question is, which of the following real estate related assets are you most interested in learning about? And you can select as many answers that apply by clicking directly on the screen and hitting submit. The next polling question should be on the screen for you now. And the question is, what is the most important role that real estate investments play in your clients' portfolios? Your answer choices to choose from are income, diversification, inflation hedge, depreciation and tax benefits, or other. And if you select other, I encourage you to type into the Q&A box, what is the most important role that real estate investments play in your clients' portfolios? And as you're getting your answer choices selected by clicking directly on the screen and hitting submit, just a reminder that we welcome your questions. You can type your questions into the Q&A box and we'll do our best to respond to as many of your questions as possible. Thank you again for your participation. And now let's get started with the first part of the class.
Hello, I'm Keith Black. In today's session, we'll look at real estate investments, as well as investments in timberland, farmland, and mining properties. There are various types of real estate investments, and we recognize that investors are drawn to real estate for several reasons. It's very familiar to us. It has different risk and return drivers in stocks and bonds, and it accounts for approximately 5% of the value of the global market portfolio. Many investors are familiar with real estate and comfortable with it. Most investors, if they have allocations to just one alternative asset class, it's usually investment real estate. It's much more widely held by individual investors than commodities, infrastructure, private equity, or hedge funds. Investors can allocate to real estate debt or equity investments. As consumers and homeowners, we're relatively familiar with the difference between real estate debt and real estate equity. Real estate equity investors purchase real estate properties to earn lease income. Some investors purchase the properties and own them directly, while others invest in funds that buy and operate buildings. Real estate debt investors lend money against real estate properties. For long-term financing, investors can originate 15 to 30-year residential mortgages or purchase mortgage-backed securities. Investors earn income from the loans and take a security interest in the property. Mortgage-backed securities pool hundreds of loans together into a bond that a government agency might guarantee. Private credit and asset-backed lending funds make shorter-term loans, often 3 to 5 years in maturity. Opportunistic real estate investors often need shorter-term capital, borrowing money for up to 2 years, which fits nicely with a private credit fund structure. Real estate developers borrow through bridge loans, construction loans, or redevelopment loans, which are repaid when the property is sold or refinanced to a long-term mortgage once the property construction or redevelopment is complete. Investors can also allocate to real estate equity, which is owning a property directly. We can buy and lease that real estate property. We're going to buy the property and directly operate it. We can find the tenants, make the repairs, collect the rent, or we can delegate those operations to a real estate fund manager or a REIT, a real estate investment trust. Direct investors in real estate buy and operate buildings, which require significant capital and operational skills, but allow for long holding periods. This is a key investment for public pension funds, which regularly purchase substantial holdings of retail, office, industrial, and multifamily properties. One of the keys to directly investing in real estate is having the capital and the operating skills, but not paying asset management fees. You're not paying an investment manager to select those properties and manage those properties for you, but you might be paying a property manager to take care of the maintenance and the rental collections and all of the other issues with operating a real estate property. Real estate investors may be able to earn substantial tax benefits. Some institutional investors are tax exempt, but most individuals have substantial tax burdens. Taxable investors can use real estate as a way to defer or reduce some of their tax burden. This is an overview of tax savings opportunities that may be available to investors, but tax laws change frequently, and not all opportunities are available to each type of investor or each type of property. Investors are encouraged to seek advice from accountants or attorneys before making any decisions on taxes or investments. Property owners have several ways to save on taxes. First, there's the depreciation deduction. Every year that you own a property, you assume that it will depreciate. The IRS assumes a useful life of 27 and a half years for residential real estate and 39 years for commercial property. In straight line depreciation, you could write off 1/27 and a half of the value of the building of that investment, but not the land each year. While the investor earns rental income, they might be able to deduct property taxes, interest, operating cost, and depreciation. All of these expenses reduce taxable income, but depreciation is a non-cash expense. Perhaps you need to allocate some new capital expenditures to the building to prevent it from depreciating too quickly. As a general rule, depreciation deduction is a non-cash expense that reduces taxable income in the current year, which earns the owner tax-favored income. When the property is sold, the investor will have to recapture the prior deductions for depreciation. If a residential building is owned for 20 years, the investor would have to pay back 20 divided by 27 and a half portion of the entire depreciable basis that we initially placed on the property when we bought it 20 years ago. Depreciation reduces our taxable income from real estate in the current year, but it defers the tax burden until we sell the property. When we sell the property, we're likely to hold it for longer than 1 year, so we'll pay taxes on long-term capital gains. That real estate income would come to us at our ordinary income tax rate, which might be higher than our long-term capital gains tax rate. When we depreciate the property, we get a deduction at our current tax rate. When we sell the property, the long-term capital gains are taxed at a lower rate. There's a bit of an arbitrage between the lower tax we pay when we sell it and the higher tax we save when we operate the property and deduct the depreciation in a given year. However, if we do sell that property, we'll need to repay those prior depreciation deductions. There are ways to further delay or even avoid paying that tax based on certain provisions in the US tax code. There's a stepped up basis at the time of death. When you die, you're able to pass along the property to your heirs, and their capital gains are going to be valued relative to the price of that asset at the date of your death and not the valuation of the asset at the date of your purchase. If you're able to hold a property for the rest of your life, that's giving a very substantial tax benefit to your beneficiaries who have a reset of that basis at the fair market value of that property in the year of your client's death. You can also defer taxes based on a 1031 or a 721 tax deferred exchange. These are very technical areas, so you have to be very careful to follow all of the rules to qualify for the deferral of these taxes. A 1031 tax deferred exchange allows a deferral of the taxable gain by reinvesting the proceeds in a similar property. If you sell a rental real estate property at a significant gain, you have 45 days to identify the property or the fund you're going to reinvest the proceeds into. You have to close on that property or that fund and buy into a similar property or fund that manages similar properties within 180 days. By following those rules, you don't book the taxable gain for the property sale during the current year, but you're able to defer that gain until you exit the property or the fund that you entered into as the 1031 tax deferred exchange. In 1031, you're selling the property and contributing the proceeds to a similar property or a property fund. In a 721 tax deferred exchange, you're exchanging the property directly for shares in an UPREIT. Rather than selling the property, you would give the property to the UPREIT, which would sell the property or integrate it into their fund. In exchange, you receive shares in the UPREIT. While invested in the UPREIT, you'll have a diversified portfolio, not holding just one property, but taking a share in multiple properties without the responsibility for coordinating the maintenance and the rent collection, which will be taken care of by the REIT manager that you deferred to in the 721 tax deferred exchange. Investors can purchase and manage a property directly. They could buy a private equity fund where a private equity fund would manage the properties for you, or you could buy real estate in a real estate investment trust or a REIT. A REIT is a company that manages real estate, with an equity REIT owning and operating real estate properties, and a mortgage REIT owning or originating loans backed by real estate. A hybrid REIT is going to mix equity and mortgages together into a portfolio. A REIT is required by law to have at least 75% of its income from real estate operations, and there's no tax on income at the REIT level as long as 90% of the income is distributed to the investors. When a company declares a corporate stock dividend, the company's profits are taxed at the corporate rate, and the dividends distributed to investors are taxed at a lower qualified dividend rate. Because the REIT as a corporation does not pay income taxes, the income that is passed through to investors are going to be taxed as ordinary income, so that the dividend coming from REITs is taxed at a higher rate than a qualified dividend coming from a stock that pays its corporate income taxes. There's a very significant difference between public REITs, private REITs, and private equity funds. A public REIT is going to be very liquid and trade on a stock exchange. There's a daily valuation at the market price. It's subject to SEC rules and disclosure requirements. It's a publicly traded company, but the volatility of the REIT may be influenced by the stock market. The volatility of REITs is higher than the volatility of the equity market. We might see 20% or higher annualized price volatility of a publicly traded REIT. Private REITs are much less liquid. The private REIT might have annual appraisals and quarterly net asset values, but those returns are going to move relatively slowly. While the public REITs have a volatility of 20% or higher, some private REITs might have an annualized volatility of returns of just 5%. Now, that doesn't mean that the hotels, the office buildings, the shopping centers, and the apartment buildings held in the public versus private REIT are different. The risk of each underlying real estate portfolio is relatively similar. There may be differences in the weights of various property types or differences in leverage, but the primary distinction between the return and volatility of a private REIT and a public REIT is 5% volatility for the private REIT and 20% volatility for the public REIT is just based on the liquidity of the asset. Because they own the same type of buildings, the economic risk is much closer than the risk calculated by the standard deviation of returns of the two fund types. Maybe the volatility of the public REIT is influenced by the equity market, and that volatility is overstating the economic risk. The private REITs are influenced by their appraisal nature and their lower liquidity, which might understate the volatility risk. Investing in private REITs or private equity funds might require an investor to be an accredited investor or a qualified purchaser. To qualify as an accredited investor, a person needs to have $1 million in net worth outside of their primary residence, or $200,000 in personal income, or $300,000 in family income. Alternatively, they could be a FINRA registered rep or a knowledgeable fund employee. Typically, investing in private vehicles requires a high minimum investment from individuals who qualify as a accredited investor or a qualified purchaser. There are no investor qualifications or minimum investment requirements for publicly traded REITs beyond the ability to buy a single share of stock for as little as $20. There are substantially higher minimum investments required in private equity funds or private REITs. The private placement exemption for funds distributed exclusively to accredited investors and qualified purchasers allows for lighter SEC regulations than on funds distributed to retail investors. Funds that qualify for a private placement exemption may be exempt from some regulations regarding transparency, fees, and leverage. REITs available to retail investors are publicly traded on a stock exchange. All publicly traded funds must follow the SEC rules and the requirements to be listed on the stock exchange. There are a wide variety of risk of real estate investments, including location, occupancy, property type, property condition, leverage, and financing. All of these contribute to the risk of investing in real estate. Real estate assets and portfolios can be designed to be relatively low risk or very high risk. Lower risk portfolios may be invested in short duration mortgage-backed securities. Higher risk investments may include opportunistic funds that purchase land and develop new properties. This map amazes me as I personally moved from Massachusetts to Tennessee and joined in this great domestic migration. Many people have changed their minds about where to live during or after COVID when they had this opportunity to work from home. From April 2020 to June 2022, there's a great domestic migration where Americans moved in search of better weather and lower taxes and lower housing costs. In just those 9 quarters, over 2 million people moved out of the brown and orange areas on the map, with concentrations leaving California, New York, Illinois, Massachusetts, and New Jersey. These locations tended to have higher taxes, higher housing costs, and more snow. At the same time, the blue areas of the southern states in the Sun Belt gained 1.9 million residents. The key beneficiaries were Florida, Texas, Arizona, Tennessee, Georgia, and North and South Carolina, where residents have moved in search of lower taxes and more affordable housing. Workers who were able to move away from high-cost markets like New York and San Francisco and keep their high-paying finance or technology job found this to be a very beneficial trade-off. You've heard that real estate is all about location. These migration trends increased occupancy rates in the lower-cost southern states that were gaining residents and reduced occupancy rates in the higher-cost coastal markets. Investors or fund managers that predicted these migration trends had an opportunity to position property investments to benefit from these changing trends in property demand. The fund could outperform by overweighting industrial and multifamily properties in those southern areas experiencing the greatest population growth. With the rise of home offices and e-commerce trends, people are ordering more online. There's been a tremendous increase in the returns and the space required for industrial and multifamily properties. At the same time, with working from home, there's been less usage and more vacancy risk in retail and office properties. Imagine the difference in returns to a real estate fund that's building new e-commerce capacity in Tennessee relative to the one that owns office buildings in San Francisco. Not only is the property type a risk, but the location is also a risk. If the manager were able to have a crystal ball to say that investing in the Sun Belt and residential and industrial properties is going to outperform, and investing in the coastal states in office and retail is going to underperform, they could significantly impact the risk and return of a real estate investment portfolio. The industry categorizes the risk and return of real estate into 4 different styles. Styles in the equity market include value and growth, while styles in the fixed income market include sovereign debt, investment grade, and non-investment grade corporates, as well as municipal bonds. Real estate styles include core, core plus, value added, and opportunistic. Core real estate is designed to be the least risky real estate investment strategy. To reduce risk, core investors purchase the highest quality properties in the best locations. The quality of a property may be determined to be Class A, Class B, or Class C. Class A properties are relatively new, well-maintained, and have high occupancy rates. They're in great locations and have low capital expenditure needs. The buildings are in prime condition, great locations, and have high occupancy rates with long-term leases to high-quality tenants. Core investors focus on 4 key property types: office, industrial, multifamily, and retail. Non-core property types include self-storage, senior and student housing, hotels, data centers and cell towers, healthcare and life sciences, single-family housing, land, and mixed-use properties. Non-core property types may have different risks than core property types. For example, the occupancy rate of multifamily properties was much less volatile than hotels during COVID. When evaluating bonds, we consider the yield and the coupon income. When evaluating real estate, we consider capitalization rates, also known as cap rates. The cap rate takes the net operating income of the property and divides it by the property value with the assumption that there's no leverage. The net operating income, or NOI, is the income earned by the property in excess of its operating costs. NOI includes all lease and rental payments received, while subtracting all expenses for capital expenditures, property taxes, operating costs, and management costs. Mortgage costs are not included in the calculation because we're looking to value an unlevered property. The cap rate is the net operating income divided by the property value. Core property cap rates vary according to the long-term sovereign debt yield. At the end of 2021, the 10-year Treasury yield was at 1.5%, just before the US Federal Reserve began to increase interest rates. Public cap rates were 4%, or a 2.5% premium over 10-year Treasury yields. Today, the 10-year Treasury yields near 4.5%, with cap rates ranging from 6% to 8.5%, depending on property type. Property types that may be perceived as riskier, such as hotels and offices, may have cap rates as high as 8.5%. Property types perceived to be less risky, such as multifamily and industrial properties, may have cap rates below 6%. As cap rates rose from 4% in 2021 to over 6% in 2025, real estate investors lost money, at least in terms of property prices. This is similar to the concept of duration, where bond prices decline as interest rates increase. The relationship in real estate is more complex, as both interest rates and the difference between interest rates and cap rates both affect valuations. As cap rates increase, NOI rises, property prices decline, or both. Core properties are going to have a relatively low return target, maybe in the 6 to 8% range today. Investors in Core Plus properties are willing to take higher risk in pursuit of higher returns, looking to earn perhaps 9 to 10% today. Core Plus has a core-like investment philosophy with looser risk parameters. While core properties might be up to 40% levered, Core Plus might be up to 60% levered. Core properties boast the best features, most desirable locations, and the highest quality tenants, resulting in very high occupancy rates. Core Plus investors may take more risks than core investors on each risk dimension, perhaps purchasing properties in less than prime locations with moderately higher vacancy rates. Newer Class A properties are typically held in core funds, while Class B properties may be popular with Core Plus investors. Class B properties might have less attractive locations or need more capital expenditures than Class A properties. In search of a cap rate up to 200 basis points higher, Core Plus investors take more risk relative to location, leverage, vacancy, and property condition. In addition, Core Plus investors hold a wider range of property types, with student housing and data centers popular in today's funds. Core and Core Plus are the lower risk investment strategies in real estate, with Core Plus taking just a bit more risk than we see in the core properties. It might be relatively easy for an investor to move directly into core property management. They buy some office buildings or some apartment buildings, they have a leasing manager and a maintenance manager, and they might be relatively hands-off as long as the properties are well maintained and the lease rates allow for relatively full occupancy. There isn't a lot of risk or management of these core properties, and Core Plus are where the majority of direct investment is expected to be in the real estate portfolio. As we transition into value-added and opportunistic investments, we're seeing a substantial increase in the risk footprint of our real estate portfolio. Value-added and opportunistic real estate are significantly riskier than Core and Core Plus properties. Value-added investors are seeking to earn returns 5% higher than Core, which is now a 12 to 15% target return from value-added. We're taking a substantially greater risk with a value-added strategy, as we might buy a property that's 50% lease, which means we're only earning half of our potential income. Perhaps we can acquire these properties with 80% leverage. Not only do value-added investors receive less income than a Core or Core Plus manager, but they also have higher leverage costs and substantially higher capital expenditure needs. What do we need to do to profit 12 to 15% annually in a value-added fund? First, we'll buy a property that's somewhat out of favor. Maybe it's 50% leased at below market rates. The property's physically tired and needs a refresh. So we buy this property and spend maybe 30% of what we paid for the property on capital expenditures to upgrade the property's condition. Once the property's upgraded, we've moved it up a class or moved it up within a class, which allows us to charge higher rents to the current tenants and potentially attract new tenants. We can certainly make money by buying a property that's 50% leased at low rents. And if we can sell it when it's 70 to 80% leased at medium to high rents, we've added a lot of value. We've brought in new tenants, increased the lease rates, and increased the property's value by overcoming some of its condition issues. When we buy these value-added properties, there are some rehab needs, but it's not a zero cash flow strategy. We do have some cash flow coming in, but we also have substantial needs for capital expenditures. The most risky strategy is opportunistic real estate, where investors have very high total return expectations of 15 to 20% or higher, with return expectations at least 10% higher than investors in core properties. Opportunistic investors may purchase completely vacant properties or buy land with the intent of developing a new property. Opportunistic investors may face substantial uncertainties due to the cost and time frame of building or rehabbing a property, as well as the eventual sales price or rental income earned by the new or improved property. There are significant risks in opportunistic real estate investment, which is illustrated on television shows of house flippers. Before the rehab project begins, there's uncertainty about the true property condition, as negative surprises often arise once construction commences. It can take months or years of substantial construction costs before the property can be sold or earn any rental income. It might take 6 months to flip a house or 3 years to build an office building. Market conditions can change substantially during that construction period. Rents or property prices may rise or fall, and it's uncertain what occupancy trends will be when our new property goes on the market. Opportunistic investors also face risk because other developers may be building or renovating similar properties in the same location. While Core and Core Plus are likely to earn substantial income today, expectations of capital gains are muted, as most of the return is derived from current income. Core investors may seek a 6% annual income and an 8% total return. Value-added and opportunistic strategies are exactly the opposite, aiming for strong long-term capital gains with potentially negative cash flow to fund development or rehab costs early in the life of the project. Investors in value-added and opportunistic properties and funds are in search of high long-term capital gains, as they might not earn much in the way of current income. How does real estate look in terms of returns and assets under management? There are a variety of strategies, as we can invest in core, core plus, value-added, or opportunistic. We can invest in coastal or southern US or in international markets. We can invest in office, retail, multifamily, and industrial properties, or any of the non-core property types. PitchBook or other data sources show that private equity real estate funds are very cyclical in their ability to raise capital. There's $160 billion contributed to private real estate funds in 2008 and less than $50 billion in 2009. Real estate was the hardest hit sector during the GFC, and there was a substantial decline in fundraising. It took from 2008 until 2019 to recover to the level of capital raised for private equity real estate in 2008. Certainly, these are big business cycles. Fundraising for private equity real estate funds and private REIT funds is dominated by value-added and opportunistic funds. When investors look to value-added and opportunistic strategies, they partner with a fund manager or developer on that strategy. Relatively few institutional investors will go it alone in value-added and opportunistic investments. You need a developer and a fund manager to do that. Core or Core Plus properties can be managed as a direct investor, where you buy the property directly and simply have an advisor for the rental and the maintenance of the building. It's easy to buy Core and Core Plus properties and manage them on your own. When you go into a value-added or an opportunistic situation, that's typically going to require the assistance of a fund manager or even a joint venture with the developer. PitchBook notes that there's $1.3 trillion invested in private real estate funds. In private markets, it's relatively difficult to measure assets, and it's especially difficult to measure real estate assets because of the direct ownership. We could say that real estate is the largest asset class in the world. We have to differentiate between the real estate that's owned for families to live in, the real estate that's owned for companies to host their operations, and the real estate that's expressly meant for investment purposes. We could say that real estate is 5% of the global market portfolio, or that it's the largest asset class on earth because most investors have more money in real estate than in any other asset class. Alternatively, we could say there's $1.3 trillion in private real estate funds, $1.3 trillion in market cap of listed US REITs, $1.9 trillion in market cap of listed global REITs, or $4.6 trillion of professionally managed real estate in the Americas, which might include some management of private funds or direct investments. Finally, there's $11.4 trillion of professionally managed global real estate. You could add on all the real estate that's owned for families to use or for corporations to operate from. Probably the hardest number to get in financial markets is the exact worth of the real estate sector. How does real estate fit into our portfolios? And why are investors attracted to real estate? We often think in terms of a 60-40 portfolio that's invested 60% in equities and 40% in real estate. Over the last 20 years, the S&P 500 earned 10% annual returns, bonds earned 3%, and real estate earned around 9%. On standard deviation and drawdown terms, real estate's fairly similar risk proposition as stocks, 11.6% relative to 15.9% volatility, and 56.5% drawdowns relative to 45.8% for stocks. So stocks and real estate have relatively similar long-term returns and relatively similar long-term risks. Where real estate truly shines is its low correlation with stocks and bonds, as well as its positive exposure to inflation. Stocks and bonds are particularly vulnerable during periods of rising rates and rising inflation. We saw that in spades in 2022 with a significant drawdown in US and global stocks and the worst drawdown in the bond market in over 40 years. In the next session, we'll discuss real assets, including infrastructure, oil and gas, and other commodities. These real assets, along with real estate, tend to exhibit relatively strong performance during periods of inflation. Stocks and bonds tend to perform poorly during periods of rising interest rates and inflation, whereas real estate and real assets often exhibit their best performance during these times. We calculated times of below average and above average inflation over the last 20 years, as well as the quartiles of inflation. In the worst 25% of calendar quarters over the last 20 years, when US inflation averaged 5.2%, bonds barely broke even, making 20 basis points a quarter, while stocks experienced substantial losses, averaging 60 basis points a quarter. During those 5 years of the highest inflation period, real estate averaged 3% positive quarterly returns. Even though stocks and real estate have similar returns over long periods of time, real estate and stocks have very different performance at different parts of the business cycle, which is very diversifying to our portfolio. While real estate had its highest return during the highest quintile of inflation experiences, stocks have their highest return during the lowest inflation periods. Stocks have outperformed during times of low inflation, and real estate has outperformed during times of high inflation. By putting real estate and stocks into a portfolio together, you're able to mute the impact of business cycles. It's an automatic hedge to some extent, as we're clipping off the tails of the losses of stocks and we're clipping off the tails of the losses in real estate by holding these two together. When real estate is underperforming, stocks are outperforming, and when stocks are underperforming, real estate's outperforming. We're reducing the range of returns for our client portfolios, which is going to make our portfolios more steady and make it easier for our clients to stick with their portfolios over long periods of time. Investors see that while they're losing money on stocks and bonds in 2022, their real asset portfolio, especially commodities, is gaining in value. This is an all-weather, highly diversified portfolio that seeks to offset factor risks. In the 10 years of quarterly observations of below average CPI over the last 20 years, when we've experienced the lowest inflation, stocks earned their highest return at 3.3% a quarter. At the same time, real estate and bonds earned 1.3% a quarter during those times of low inflation. When inflation is above average at 4%, real estate earned average quarterly returns of 3.5% compared to stocks at 2.2%. Adding real estate and real assets into our portfolio, as we'll see in the next section, can substantially reduce our portfolio risk during times of rising inflation and rising rates. A substantial risk of moving from public funds into private funds is the dispersion of returns in private real estate investments. The dispersion of returns between the bottom and top quartile managers in public equities or public fixed income might be 4% or 2% a year. The dispersion between the middle 50% of real estate managers is on the order of 10% per year. While a good equity manager may outperform a bad equity manager by 4 or 5% a year, the dispersion is more than double that as we move into private real estate. It really matters whether you're in the coastal cities versus the Sun Belt, core versus opportunistic, or office versus multifamily. The manager and the strategy have the ability to add or detract substantial value. The four main property types are industrial, retail, office, and multifamily residential. We could average those together into a diversified portfolio. Maybe the manager is making some calls as to whether what style or strategy to overweight, and then you'll see the returns to mortgage funds as well. Notice the volatility of the returns to the retail and office properties. Sometimes we'll see that the retail properties in blue have very strong returns, Look at 2010, 2011, 2012, making 12%, 26%, even 33% per year. But in 2020, retail had a very hard time, down 25% during the COVID-19 shutdowns. The market experienced a strong shift as office returns tend to be above average from 1994 to 2008. If you follow the office sector in yellow, it tends to be relatively strong in the top half of the chart. During the same time period, industrial properties in green had relatively middling performance, while residential properties in orange tended to underperform. From 1994 to 2008, returns to office and retail investments were leading, while the returns to industrial multifamily residential properties were lagging. Those trends reversed after the GFC, with residential and industrial sectors earning strong returns over the last 15 years. Notice the 40% return to residential in 2014 and 46% in 2010. Consider the recent returns on industrial properties, 30% in 2016, 20% in 2017, and 62% in 2021. A manager who overweighted residential and industrial properties in the Sunbelt states did extraordinarily well, but the managers who overweighted retail and office properties in the coastal cities probably did fairly poorly. In 2022, office properties declined in value by 37%. And then look at the difference in returns between office and industrial in 2021. 22% for office relative to 62% for industrial. Property type and location matter, and the ability of the manager to execute is also very important. The manager's view as to location or property type has a substantial impact on returns. Over the last 20 years, equity real estate and US equities like the S&P 500 had relatively strong returns, making 8 to 9% with 10 to 15% volatility. Equities and real estate have similar risk and return statistics, but because real estate and equity tend to have a very low correlation of returns, and equities tend to have a negative exposure to inflation, and real estate can have a positive exposure to inflation, adding real estate and real assets into an equity portfolio can serve to add substantial diversification. Diversification is good for investors as it reduces the highest returns and clips off the big drawdowns, like we saw in 2022. At the same time, real estate may provide more income to investors than an equity portfolio. In addition to real estate, other real assets offer inflation hedging potential. We will discuss timberland, farmland, and metals and mining in this session, as there are some commonalities with real estate. The next session will discuss infrastructure, oil and gas, energy transition, and commodities, including energy, food products, and industrial and precious metals. Some of these real asset strategies have a substantial income component, as well as that inflation hedging component that we see in the real estate market. Moving along to timberland, farmland, and metals and mining, which are a relatively small sector of real assets. In 10 years of fundraising, this sector raised less than $100 billion combined, with less than $10 billion raised in some years. So there's not a lot of capital moving into these areas of timberland, farmland, and metals and mining. But they're very interesting stories. In an environmental sense, the best investment might be timberland, because you're actually preserving large tracts of forest, and trees are a carbon sink. The more trees there are, the more carbon environment. As a timberland investor, you literally buy hundreds or thousands of acres of forest to hold as a long-term investment. Now, you might not see a substantial capital. Timberland tends to be relatively remote to population centers, but there are regular revenues from selling timber into the lumber market. You buy thousands of acres of trees and cut down 2 to 5% of the trees each year. When you cut down trees as a logging operation, you sell those trees into the market to be used to build furniture or housing. You receive compensation for the biological growth of the trees that you planted. In addition to the revenue that you could earn from cutting and selling that lumber, you also have the potential to earn revenue from the sale of carbon credits, land conservation easements, or even renting the land for recreational purposes such as camping or hunting to provide additional sources of revenue. Of course, there are risks to timberland, such as forest fires, spotted owls, or tree-eating beetles. Another risk is the cyclicality of lumber prices. Sometimes lumber prices are very high, especially when housing starts are strong at the top of the economy, and there's a tremendous demand for logs to be used for furniture and housing. At other times, perhaps immediately after 2008, housing starts can be low, and the volatility of lumber prices is high. Demand for lumber products can decline during times of low housing starts. Most investors are not likely to invest directly in a forest, but can access this asset class through publicly traded REITs or through a timberland investment management organization, or a TIMO. TIMOs have similarities to a private equity fund or a private equity real estate fund, where they would own and operate the asset for the 10-year life of a fund. The management team would decide on which trees to plant and which trees to cut, and manage the financial operations of the forest as not only an investment manager, but also an asset manager and a caretaker of your forest. There are some very interesting biological implications of owning a forest. Each year, the forest manager plants and harvests trees, with the choice to harvest and what types of trees to plant. Each year, 1%, 2%, or 5% of the trees are harvested. Every time you cut down a portion of your forest, you should be reseeding trees. So 20, 30, or 40 years from now, and once again harvest trees. It's a very long-term investment. You cut down the 30-year-old trees, you plant new trees, and then 30 years you come back and cut down the trees again. It's sustainable and very long-term. Trees can take 30 to 60 years to reach maturity, depending on the species of tree. All have different growth rates, uses, and economic values. Larger trees are inherently more valuable than smaller trees. A larger tree has more lumber than a smaller tree as measured by board feet. The larger the tree grows, the greater its value and the more uses it has. You've all seen these lovely live-edge dining room tables that are 12 feet long and 5 feet wide. You need a substantial sized tree to produce a table of that size from a single piece of wood. The uses of very small trees may be limited to uses such as paper or 2x4s. The larger the tree gets, the greater its economic value, not only in board feet, but also in dollars per board foot. More mature trees are more expensive than less mature trees, even on a board foot adjusted basis. There's an entire class of economists who think about real options. Real options are the option to take or not to take an action in a corporate finance context that can add significant value to your operation. The price of lumber is volatile over the business cycle and levered to the health of the home building industry. Lumber prices fell by half from 2005 to 2009, as there were few housing starts during the GFC. Lumber prices doubled from their 2009 lows through 2010 and 2012. When you get into a housing boom, there could be a tremendous demand for lumber, and the prices can significantly increase. There's not a rule that says which trees and how many trees must be harvested each year, as a forest manager has discretion over these decisions. When trees are harvested, they're sold into the lumber market, and income is earned for the owner of the timberland. If the forest manager leaves the tree on the stump for another year, it will grow 2 to 3% larger. Consider the implications of not harvesting any trees from 2008 to 2011. The owner of the timberland did not earn any income from lumber sales for 4 years, but sold 4 years worth of harvest in 2012. Not only did lumber prices double from 2008 to 2012, but each tree grew 10% larger while it was waiting to be harvested. When the harvest is delayed during times of weak lumber prices, you're reinvesting in the potential increase in future lumber prices, but also earning additional biological growth of the trees. Investors in agricultural land purchase acres of farmland. Rather than operating the farm, most agricultural investors lease the land to local farmers. Some investors may change from a crop with high water needs to a crop with low water usage, allowing for lesser water usage and the sale of water rights. Even more water can be saved if fewer crops are grown and the land is used to generate electricity from solar panels or wind turbines. Some farmland may have multiple sources of revenue, such as simultaneously growing crops and generating power through solar and wind. Farmland can be used to grow permanent crops or row crops. Permanent crops are trees and vines for growing grapes, citrus, or nuts. Almond trees, grapevines, and orange groves will remain in place for 10, 20, 30 years or longer. Once you've committed to growing almonds or oranges, you're going to continue to grow almonds or oranges for as long as you can keep those trees healthy. That's different than row crops. What most of us think of as farmland is driving down an interstate highway and seeing miles and miles of corn or wheat or soybeans being grown in the fields. Each year, the farmer can choose which row crop to plant. If they think that corn prices are going to be relatively high and wheat prices are going to be relatively low, the farmer has a choice to plant corn this year and not wheat. The problem is if everyone chooses corn instead of wheat, then maybe that year wheat prices will be strong because there's a shortage and corn prices might be weak because there's a bumper crop. Many private equity farmland investors will lease the land to farmers with inflation-adjusted rents that are charged in dollars per acre plus a percentage of the dollar per bushel yield. Investors can enter into a leasing agreement with the farmer where the rent is determined not only by the acreage, but also by the production from that acreage. You might earn a specific portion of the value of the oranges or the corn that's sold from that farm in any given year. If there's a significant increase in the price of oranges or corn, that farmland investor would share in the increase in production and the increase in prices, creating an inflation-linked asset. The higher food prices go, the higher the rent from your farmland investments. A large farmland owner might provide access to technology and agronomy to the farmers renting their land, perhaps lending them a tractor driven by satellites and artificial intelligence. Today, tractors can optimize the amount of fertilizer or water that's applied to each 1/10 of an acre on the farm, as satellites can sense the dryness or the moisture in the soil. This can maximize the crop yield, increasing the output of corn, wheat, or soybeans grown on each acre. Adding value to the farm through technology can increase crop yields and therefore increase the rent due to the farm owner. You may have heard that they're no longer making any more farmland. In fact, the amount of available farmland is shrinking. As the whole population increases, the demand for agricultural products also rises, while farmland is converted into housing to accommodate the growing population. For every 100 acres of corn that gets turned into houses, there are residents of those new homes who will consume more corn, but there are 100 fewer acres of productive farmland in the world. This can be an especially virtuous cycle for the farmland owners because the demand continues to grow for farm products while the supply of farmland continues to decline. Growing demand and declining supply typically leads to higher prices. Farmland has a high cash yield with low volatility and a low correlation to the returns of financial markets. Now, the most profitable thing that a farmer can grow on their farm, it's actually houses. While farmers may be able to sell land to housing developers, that opportunity is less frequently seen with timberland because forests tend to be relatively remote, as people don't necessarily live near the 10,000 acres of forest. But by definition, farmers live near farmland. If farmers live in a region with a rising population, they have the ability to sell their land to home developers. I used to live 50 miles north of Chicago, and every year we saw another 100 acres of corn plowed under to make way for a new housing development. A farmer who lives 50 to 100 miles away from a major expanding city may have the opportunity to sell their farmland for a very high price. Farmland might be priced near $10,000 an acre, but housing tracts might start at $50,000 to $100,000 an acre. Some farmland investors specifically purchase and operate farms in the path of development, hoping to have a significant liquidity event by selling their farmland to housing developers. Investors can buy mine to profit from metals and mining. They can search for precious metals such as gold, silver, platinum, and palladium, or industrial metals such as copper, aluminum, and nickel, or energy metals such as lithium, cobalt, and rare earth metals. Mining can be a dangerous place to invest because the mine may provide a return that differs substantially from simply owning the metals. You can have a far higher return than simply owning the metal by discovering a large deposit, or you could lose multiples of your investment if the mine creates an environmental liability. The environmental stewardship part of this is paramount. You must be exceptionally cautious in the way you operate your mines. There's also some volatility here. You need to have good geologists, because if you buy a property in search of 1 million ounces of silver, you could get substantially less than that and have lower financial returns or even losses, or you could have substantially greater production from the mine and returns are substantially greater than expected. Not only is there the risk to the downside of environmental issues, but there's also the risk of downside to the mine having less metal than you projected. If you have a good relationship with your miners and they're productive and efficient and they don't go on strike, if you're environmentally responsible and there's a substantial upside in the ounces of the metal you find in your mine, metals in mining can be a very significant and positive investment, but it's not for the faint of heart.
Before we continue, we'd like to get your input on a couple of additional polling questions. The next polling question should appear on the screen for you now, and that question is, what infrastructure and resource-related assets are you most interested in learning more about? And you're welcome to select as many answer choices that apply. Your answer choices to choose from are infrastructure stocks or ETFs, private and infrastructure funds, mining and resource stocks, physical commodities or futures, private funds in energy, timber, or agriculture, investments in renewable energy, or your last answer choice is none of the above. Again, the question is, what infrastructure and resource-related assets are you most interested in learning more about? And as a reminder, materials are available for you to download in the Documents folder at the bottom of your screen. This brings us to our final polling question of the day, and that question should be showing on the screen for you now. What are the most important roles that infrastructure and real assets play in your clients' portfolios? And again, you can select as many answer choices that apply. Your answer choices to choose from are diversification, inflation protection, income enhancement, improving the environment, or other. And if you select other, I encourage you to please type into the Q&A box, what are the most important roles that infrastructure and real assets play in your clients' portfolios? And you can select your answer choices again by clicking directly on the screen. And thank you again for your participation. Now let's get back to the next presentation.
Hello, I'm Keith Black. In today's session, we'll be discussing infrastructure and real assets. We've already looked at the inflation hedging power of real estate, and now we'll expand that to this wider category of real assets. Real estate is the most popular and largest category of real assets, but investors can also allocate to infrastructure, physical commodities, oil and gas, metals and mining, timberland, farmland, as well as the energy transition. Relative to real estate, private equity, or hedge funds, the private funds for real assets are relatively small. They've raised about $1.3 trillion over the last 10 years. Of that, the vast majority has been in infrastructure, as well as in oil and gas. There's been a much smaller pickup of institutional investors allocating to timberland, farmland, and metals and mining. The main reason why investors allocate to real assets is to hedge inflation risks. Over the last 20 years, the 25% of quarters with the lowest inflation averaged an increase in CPI of about 0.6% per year. The 25% of quarters with the highest inflation rate over the last 20 years averaged 5.2% inflation. Notice the pervasive effect that inflation has on investing in stocks and bonds. When inflation is low, the Bloomberg Aggregate Bond Index averages quarterly returns of 1.4%, and the S&P 500 Index averages returns of 4.3% during those times of the lowest inflation. When inflation is raging at an average of 5.2% annually, stocks have a negative quarterly return of about 60 basis points. And that's over every quarter in the worst inflation over the last 20 years. This is a 5-year period where stocks on average had a negative return and bonds had a positive return of 20 basis points per quarter. When inflation is low, stocks and bonds do very well. But when inflation is high, stocks and bonds tend to have 0 to negative returns. This is the time to talk about real assets. The PitchBook Real Assets category combines infrastructure, oil and gas, metals and mining, timber, and agriculture. When inflation is low, stocks outperform all real asset categories. When inflation is low, oil and gas has even averaged a negative return. When inflation is high and stocks are declining in value, quarterly returns to the Bloomberg Commodity Index are 1.3%. Metals, timber, and agriculture earn about 1.5%. Oil and gas earns as much as 6% a quarter, infrastructure at 3.3%, and the broad real asset category earns 4.6% per quarter during the times of the highest inflation. If you're investing simply in that 60-40 portfolio, you tend to do very well during times of low inflation. But when inflation's at its highest, that's when it pays to be invested in these real asset categories. We've already proven the same characteristics of investments in real estate. What's even better is that you don't have to give up returns to get that inflation protection. Over the last 20 years, the average annual return to the S&P 500 is 10.1%. We see oil and gas at 13.8%, infrastructure at 13.8%, and real assets at 14.3%. In addition to hedging the inflation risk inherent in equity and fixed income portfolios, investors might earn equity-like returns by investing in some of these real asset categories. Oil and gas investments have similar risks, returns, and drawdowns as equities. Infrastructure tends to be less volatile than other categories of real assets, and you still get that equity-like return. Imagine having a diversified portfolio. You assume that stocks and bonds are all the diversification you need, but then 2022 comes along, and you see the worst drawdown in 50 years for the bond market. At the same time, stock prices are declining. But many of these real asset categories actually posted profits in 2022. When we're building a diversified portfolio, it's not about the names of the assets or the description of the assets. It's all about the correlation of the returns of assets to the returns on other assets, as well as to risk factors. Both stocks and bonds have a negative correlation to inflation, with stocks at minus 0.2 and bonds at minus 0.4. The higher inflation goes, the lower the expected return to stocks and bonds. In contrast, all of the real asset categories have a positive exposure to inflation. Oil and gas is the highest at 0.36, and a diversified real asset portfolio comes in at a 0.25 correlation to CPI. While stocks and bonds have a negative correlation to inflation, all of these real asset categories have a positive correlation to inflation, and they tend to have their highest returns when inflation is moving along at a nice clip. The lower the correlation, the greater degree of diversification. Look at the correlation of these real asset categories to both stocks and bonds. We see that the correlation of real assets to stocks ranges from 0.16 for infrastructure to 0.47 for the Bloomberg Commodity Index. The highest correlation of bonds is 0.12 for infrastructure, and the lowest is minus 0.24 for oil and gas. If we have a negative correlation of bonds across the board, a correlation of 0.2 to 0.4 to stocks, adding these real assets to your portfolio is going to be diversifying not only your stock and bond risk, but also your inflation risk, while at the same time offering you long-term equity-like returns. Infrastructure has gained the vast majority of real asset allocations over the last 10 years. Infrastructure is a very interesting asset class. It includes roads, seaports, railroads, airports, electric generation and transmission, data centers and cell towers, water, energy storage and pipelines, renewable energy, and then the social infrastructure of schools, hospitals, and housing. There are a number of reasons why infrastructure might have high returns, a high correlation to inflation, and a low correlation to stocks and bonds. Let's discuss airports and seaports, the electric grid, the water system, and energy pipelines. These are monopolistic assets. In most locations, there's one electric grid, one water system, maybe two, but these are monopolistic assets. They're relatively immune to competition when you have a gas pipeline, when you have a water distribution system, or an electric generation capacity, because these are monopolistic assets without a lot of competition. But at the same time, when you don't have competition, you also notice that these are low beta assets. Whether people have jobs or consumer confidence or not, they still find a way to pay their water bill and their electric bill, these necessities of life. We're not seeing a significant cyclicality of the revenue to an energy pipeline, an electric grid, or a water system relative to GDP growth. Because we have this low cyclicality of returns and these monopolistic assets, they tend to be relatively insensitive to economic developments that might trigger volatility in the stock or bond market. Many of these assets are explicitly inflation linked. The contracts they have with their customers or the government explicitly allow prices to increase at the rate of inflation or some formula tied to the rate of inflation. Monopolistic assets are often subject to a utilities pricing commission at the state or local level that will control their price increases. You can't act like a monopolist and charge everyone $1,000 a month for their electric bill, but you have the ability to pass through inflationary price increases along to your users. There are many beneficial qualities to the infrastructure asset class. Cash flows may contractually rise with inflation, the businesses have monopolistic characteristics, and a low cyclicality of demand. Infrastructure has historically offered equity-like returns with lower volatility and drawdown risks than equities. This may come from the illiquid nature of infrastructure, and in many cases, infrastructure funds are structured similarly to a private equity drawdown fund. There's not a lot of liquidity in this asset class, but the nature of the assets tend to be less volatile than most operating companies. The reason they're less volatile is because they tend to have this monopolistic power. They're relatively immune to competition and can pass along the rate of inflation and their low beta assets relative to the business cycle. We can compare infrastructure in some ways to real estate in that there's a significant physical component to these assets that create cash flow. Infrastructure can also be compared to private equity and venture capital. A key distinction between infrastructure funds and private equity funds is that infrastructure assets are paying out substantial cash flows. When people pay their electric bill or their water bill, or when they travel through a seaport or an airport, all of those fees are subject to being paid to the infrastructure equity holders or the infrastructure debt holders. We can talk about infrastructure as being extraordinarily low risk, but there are different factors that influence the risk of infrastructure assets and infrastructure funds. We could invest in infrastructure in a very low risk way, or we could invest in infrastructure in a very high risk way, depending on how we finance those assets, the type of assets we buy, and whether involved with infrastructure debt or infrastructure equity. We can discuss the gradations of risk in infrastructure relative to core, core plus, value added, and opportunistic strategies. These are the same categories we saw in real estate. On average, infrastructure debt is lower risk and infrastructure equity is higher risk. Many of these assets are subject to governmental partnership or governmental oversight. A key distinguishing factor in the risk of infrastructure is whether it's a greenfield or a brownfield asset. Let's start off with these distinctions of core, core plus, value added, and opportunistic strategies. As with real estate, core is expected to be the lowest risk and lowest return investment, and opportunistic is expected to offer the highest risk and the highest return. Core assets are focused on currently operating monopolistic assets in developed markets with low degrees of leverage. You're buying the electric grid, the water grid, the airport, or the seaport that's already operating. There's not a competing asset within a closed geography, and these assets are in G10 developed markets where there's a rule of law and strong contracts. Core infrastructure assets are financed with low degrees of leverage. Core plus infrastructure assets are still focused on projects that are currently operating. Investors can see the value of those assets, the operating history, the cash flow of those assets. But in Core Plus, we could also move into more competitive assets. Those more competitive assets might include schools or hospitals, workforce housing, data centers, and cell towers. All of those are more competitive assets that don't necessarily have that degree of monopolistic safety for the investor. A Core Plus fund might add a bit more leverage than investors would experience in a core fund. Similar to the case in real estate, value-added and opportunistic strategies have substantially greater expected risk and return than core and core plus strategies. Value-added strategies seek to purchase undervalued assets and increase their value through expansion or operational improvement. There's a great example of an infrastructure fund that purchased an airport. That airport had low passenger growth, a bad reputation, due to its inefficiencies and a location that was difficult to access. So after the private equity infrastructure fund bought the airport, they added access to the airport through a new light rail route, and they improved efficiencies in baggage handling, on-time departures. So the airport became actually preferred to the larger international airports in the area. Now, opportunistic infrastructure can be extraordinarily risky. This might be working with a greenfield project. In a greenfield project, it's a green field. There's just a bunch of grass sitting there waiting for something to be built on. So then you say, I want to build an airport or a toll road on top of this empty field. There's a tremendous amount of risk that comes with this development strategy within the opportunistic funds. You might be taking commodity price risk or emerging markets risk in an infrastructure fund. All of those fit in the opportunistic category of infrastructure. It's relatively easy to be a core or core plus manager or a direct investor in real estate. You buy and directly own the property for a very long holding period. You hire a local property manager to collect the rents and perform the maintenance. Now, it's not necessarily as easy to be a direct investor in core or core plus infrastructure or an owner of infrastructure assets because of the scale of the investments and the complexity of the investments. The electric grid, the water grid, an airport or seaport, they're very large capital intensive assets that need a lot more maintenance and a much larger scale of investment than a single real estate asset. So there's less of a tendency for pension fund investors to move directly into core and core plus infrastructure, even if they're comfortable as a core or core plus real estate investor or a direct owner of real estate. Over the last 10 years, about 2/3 of fundraising for infrastructure funds was destined for core and core plus funds, while value added was about 1/3, and opportunistic funds raised minimal capital in most years, with the exception of 2022. There are a variety of investment vehicles that offer access to infrastructure assets. Certain sectors are widely available in the publicly traded equity markets, including electric, gas, and water utilities, railroads, solar and wind electricity generation, data centers, and pipeline MLPs. But there are some relatively unique assets that are generally not publicly traded, at least not in the US. Schools, roads, airports, and seaports are more often privately held. There are a few public equity listings in non-US markets, but these assets are primarily available only through private equity infrastructure funds. These relatively unique assets might have a lower volatility and a lower correlation of returns. Both public equity and private equity assets are equity investors. They're going to take an equity ownership stake in an infrastructure project. It could be a 100% stake, a majority stake, or an operating lease from a governmental entity. Some investors prefer to allocate to infrastructure debt and lend to the developers or the operators of those infrastructure assets. One of the key distinctions of risk in infrastructure projects is greenfield projects relative to brownfield projects. Brownfield projects are the lowest risk projects that are already existing and operating assets with a track record of usage, revenues, and expenses. High-risk greenfield projects that are building a new infrastructure asset may be subject to delays and cost overruns. We don't know how long and how many millions of dollars it's going to take to build this asset. You might plan to build a football stadium with a construction budget of $200 million, but at the end of the day, it costs $300 million or more. You don't know what those cost overruns are going to be, and those cost overruns could substantially influence the final outcome, the final return to investors. Investors are also concerned about the extra time and the cost that it may take to bring a new infrastructure project online. An even bigger potential issue is the uncertainty of cash flows of newly built projects. Every once in a while, investors spend hundreds of millions of dollars on an infrastructure project, and they find that they built a new toll road, and they find that no one wants to pay to drive on the road, and the car counts, the revenues are 80% less than expected. This causes substantial losses for infrastructure investors who overestimated the willingness of the residents of that geography to pay to access that toll road or other infrastructure assets. Not only do greenfield investors have the risk of construction delays and cost overruns, but they also have the uncertainty as to what cash flows that newly built asset is going to generate. Brownfield investments that are already in place and already cash flowing are much less risky than investing in greenfield assets. When we get involved with a brownfield project, we know ahead of time exactly what it's going to cost us to get involved, which is not necessarily the case with greenfield projects. What is the role of governments relative to private investors in this infrastructure business? We know that there are trillions of dollars around the world in infrastructure needs, which could attract substantial investments of private capital. Each government wants to encourage infrastructure build-outs that can grow their GDP and make their economy more efficient. We just talked about this greenfield brownfield problem. Private investors are more comfortable investing in the brownfield projects. They know exactly what it's going to cost to get involved, and they have history of operating expenses and revenue, which can be built into financial models. The government might be willing to work with the private sector to develop and operate infrastructure needs. Investors may believe that private operators of these assets might be more efficient than government operators of these assets. However, the private capital that's invested in infrastructure might be hesitant to invest in greenfield projects because of the time delays of building these projects and the cost overruns and the uncertainty of cash flows. Maybe there's room for governmental entities in the public sector to work together with private sector infrastructure investors to come up with a solution. In some cases, it's a privatization or a public-private partnership. If the private investors are hesitant to take on greenfield risk, the government can develop a project. The government builds the airport, the toll road, the electric grid, or the water grid. The government funds the project and takes the risk of cost overruns and time delays in building the project. Once the government funds the project and gets it operational, the project has been de-risked. Private sector investors can see the cash flows and the cost of getting involved with the infrastructure project. So the government will run that asset for a couple of years, we'll see the cash flows and the traffic counts, and then private investors can come in and invest at brownfield levels of valuation and expected returns, which are lower risk and lower expected returns than getting involved with the risk of a greenfield project. So the government builds the asset, they finance the asset, they take the risk of the cost overruns and the construction delays. The government operates the asset for a year or two to establish that history of cash flows and traffic, and then the government can privatize that asset by selling it into the infrastructure market. Now that asset becomes privately owned and privately operated. If it's a monopolistic asset, it's still subject to governmental oversight. The government may maintain regulatory controls over the quality of the service and the price that can be charged. While the asset may be a natural monopoly, the government seeks to prevent the private owner from acting like a monopolist and taking advantage of consumers. If the citizens don't like how the asset's being operated, the government has contractual terms that allow the asset to be bought back by the government or for the government to increase regulation of the asset. A public-private partnership is where the asset is owned by the government and leased to the private sector operator. The government doesn't want to relinquish control, but believes that the asset can be run more efficiently in the private sector. A long-term lease of the asset may earn tens or hundreds of millions of dollars in an upfront payment to the government, and those assets can be used to further develop other infrastructure projects. In exchange, the infrastructure operator earns all revenues and pays all expenses for the term of the lease. The government still owns the asset and has a contractual relationship where they can limit the actions of the operator of the asset. Environmental, social, and governance issues are key concerns for infrastructure investors. Infrastructure assets can have a substantial environmental impact. We have to consider the sustainability and pollution potential of large-scale construction projects, such as seaports and airports. What type of materials are used? Will we construct green buildings? These are considerations during these large greenfield projects. When we're working with electricity, water, roads, and airports, there can be substantial environmental impacts of these projects. The private equity infrastructure managers and investors are going to be held accountable for any negative environmental impacts. Whether you're investing in this as a green project or not, the operator must take corporate responsibility to manage the asset in a way that will not have a negative impact on the citizens or for the reputation of the government. Anytime you're involved in an infrastructure project, you have to be very careful in the way that it's run to not harm the environment. Some people will invest in infrastructure specifically for the financial returns or simply the ability to hedge inflation in their portfolio and have a diversifying asset relative to stocks and bonds, while others might invest in infrastructure specifically for the environmental benefits. So those investors in infrastructure might look to invest in green assets and renewable energy. Certainly they'd like to earn returns, but they might not earn the full returns that a fully capitalistic investor might earn on their infrastructure investment. They're there not only to make money, but also to make a difference. So those investors are going to choose to invest in projects that provide clean water. They want to invest in renewable energy like wind and solar that reduces the world's carbon footprint and the reliance on oil and gas and coal. They might want to invest in real estate, but do it in a way that provides affordable workforce housing that's available for people with average to lower incomes. Investors may specifically choose an infrastructure fund that's designed to further these economic, environmental, and social goals. Some investors will allocate to a diversified commodity portfolio, which might be available as exchange-traded products, including exchange-traded funds or exchange-traded notes, ETFs and ETNs. You can invest in a benchmark portfolio that follows the return of the Bloomberg Commodity Index. Some investors might allocate just to gold or just to oil. But there are important properties of investing in a portfolio that's fully diversified and benchmarked to the Bloomberg Commodity Index. There are 24 different markets that are held in the Bloomberg Commodity Index. This includes 6 energy futures markets that make up 30% of the weight, 5 industrial metals markets that make up 15% of the weight, 2 precious metals that make up 18% of the weight, and 11 markets of grains, softs, and livestock that comprise 35% of the index weight. This index invests in a combined portfolio of industrial metals, precious metals, energy, and food products. What's very interesting is that the return to the Bloomberg Commodity Index is similar to the return to the energy commodities. But energy alone has more than twice the volatility of the fully diversified Bloomberg Commodity Index. That means that adding metals and food to the commodity basket brings strong diversification powers to the index, given the low correlation between the prices of energy, precious metals, industrial metals, and the food products. Now, energy and industrial metals markets are very different than the precious metals and the food markets. Let's discuss energy and industrial metal markets first. Energy and industrial metals are by far the most volatile commodity sectors because prices can increase quickly during times of supply shortages, which can last for years. Equity investors typically think that bad news makes markets move lower. However, bad news in energy and industrial metals often leads prices to move substantially higher. What we care about is a spike in demand or a curtailment of supply. When demand is strong and supply can't keep up, the production of energy and industrial metals cannot immediately respond to the increase in demand. In some cases, there's an increase in demand where it can take 5 years or longer for supply to increase to meet that level of demand. Right now, we think about energy storage. We're thinking about data centers, cell towers, and renewable energy. There's a tremendous demand for copper to build out all of this other infrastructure. And if the copper mines are producing at full capacity, it's going to take quite a while to find a new copper mine with new capacity. In some cases, there's an increase in demand where it can take 5 years or longer for supply to increase to meet that level of demand. Energy markets include investments in natural gas, gasoline, diesel fuel, gas oil, and crude oil, both in the UK through Brent and the US through WTI, West Texas Intermediate. Industrial metals include copper, aluminum, zinc, nickel, and lead. The gas and the oil and the copper are buried under the ground, and we don't necessarily know where. If the world wants to have a new source of copper or a new source of gas production, there needs to be an exploration to find where it's buried in the ground. Once the deposits are located, investors need to buy or lease the rights to drill or mine in that area, as well as get the environmental permits. We need to go under the ground to access these deposits and extract the commodities through mining and drilling. Once the materials are above ground, we need to secure refining or smelting capacity, which itself might be in short supply. These markets are extraordinarily volatile, as demand can exceed supply for many years. If you need natural gas or aluminum to run your business, those prices can spike substantially during times of excess demand and reduced supply. In times of excess demand, it might take 5 years to bring this new supply online, as we find new lead mines or drill new oil and gas wells. 5 years from now, we have exactly the opposite problem. There'll be more natural gas and more lead. So if it takes 5 years to bring that new supply online, we're building for the demand 5 years ago. So when demand is strong, there are many investors in new supply, which might come online after the demand surge has started to decline. That is, new supply comes online during a period of weak demand, which can lead to a 5-year cycle of negative price developments once the supply finally exceeds the demand. So these markets are going to cycle between times of oversupply and overdemand, which causes tremendous volatility in the prices of energy and industrial metals. The price of oil briefly went negative during COVID due to the low demand for travel. People weren't traveling in airplanes or trains, and car travel was also substantially reduced. The demand for oil and gas was low and the supply was high. Now, crude oil is actually worthless if you don't have a place to store it, such as a tank farm or a shipping vessel. That oil has to go somewhere. But this volatility shows us that prices can move from negative to over $100 a barrel in just a couple of years. This tremendous volatility in the price of energy and industrial metals is leveraged to the inflation rate, because the time when excess demand is overwhelming supply is when the economy is experiencing peak levels of inflation and GDP growth. Energy and industrial metals can be fantastic hedges against inflation and tend to perform well during times of high GDP growth. Precious metals are the least volatile commodity sector because market prices don't react strongly to the amount of gold mined in any given year. There's a tremendous amount of gold that's held in jewelry or coins for investment purposes and central bank reserves. This year's production or supply is relatively inconsequential for the price of gold. What matters much more is the current demand for jewelry, gold investment, and from central banks. There's a substantial inventory of gold and silver, making this year's production relatively inconsequential for the price. Gold and silver have some commonalities with currency markets, as they're sensitive to inflation and often increase in price when the dollar is declining in value. Gold was priced at $35 an ounce when the US ended the gold standard in 1971, and today it's well over $3,000 an ounce. As inflation compounds and the value of the dollar declines, gold has been a great store of value. $1 today buys much less gold than it did in the past because either the value of gold increased or the value of the dollar was debased. Silver, platinum, and palladium have significant industrial uses, including electronics and automobile emissions. So we have the industrial metals, the precious metals, the energy products, and the fourth category of investments is the food complex. The key determinant of food products is the amount that's harvested or bred in the current year. Weather is a key determinant of the volatility for grains, softs, and livestock prices. If the weather is favorable, you might have extra corn and extra wheat in a bumper crop. There's a huge harvest and prices might be weak. But if there are floods or droughts, some of that crop may be destroyed or the yield is much lower than anticipated. There can be much less production than anticipated and prices can move substantially higher. A key part of the dynamic is that food commodities have a limited time to store before they might spoil. We have to understand how food can be stored and what that spoilage factor might be. We could hold gold bullion for millennia. However, the ability to preserve the value of cattle or hogs is much less than the ability to hold gold for long periods of time. We don't see booms and busts of food prices lasting for long periods of time. If the weather's bad in one year, or if there's bird flu in one year, prices might increase. If that disease goes away the next year and the floods and the droughts turn into the perfect amount of rain, the next year could produce an oversupply and keep those prices in check. Over long periods of time, the return on food products are similar to inflation. Grains in the Bloomberg Commodity Index include corn, wheat, and soybeans, which are split into soybean meal and soybean oil. The softs include coffee, sugar, and cotton, while livestock includes live cattle and lean hogs. Let's dive further into the energy complex with oil and gas. Not every oil and gas investment has the volatility of investing in oil or gas futures markets. It depends on whether the investment is upstream, midstream, or downstream. Midstream investments, such as storage and transportation, have the least exposure to commodity price volatility. Midstream investors are more concerned with the volume of energy shipped or stored than with the price of the energy products. Are there enough barrels of oil or enough MCF of gas to keep the pipeline or the storage tanks full? Revenues to midstream investments are based on the amount of energy stored in the tank or transported by the pipeline or in your ships. Downstream investments include refining, marketing, and distribution. In the refining process, crude oil is cracked into products, including diesel fuel, jet fuel, gasoline, and even asphalt, which comes out of a barrel of oil. The crack spread is an important driver of profits of refinery marketing and distribution. If the refiner purchased a barrel of oil for $90, they might sell that barrel of gasoline and jet fuel for $100 for a crack spread of $10 or $120 for a crack spread of $30. You care about the market's perception of value added from that refinery or how much you're getting paid to turn the crude oil into unleaded gasoline. The greatest volatility as an energy investor is going to be in the upstream category. This is E&P, exploration and production. These are the drilling investments that are sensitive not only to energy prices, but also to the ability to find deposits. You certainly care whether oil is going to be $50 or $100 a barrel, but you're also concerned with whether the volume of the oil or gas well produces is above or below the anticipated yield. Vertical wells and horizontal wells have different costs and benefits and potential yields, and the addition of fracking may also impact drilling efficiency. When you're invested in oil and gas upstream, you have the volatility not only of the price of the barrel of oil, but also the number of barrels of oil that will be produced on your land or in your drilling projects. The US government offers very substantial tax benefits of investing directly in oil and gas to all investors, with the exception of the oil majors. Small operators that aren't Exxon, Chevron, or ConocoPhillips are allowed to earn very substantial tax benefits for developing exploration and production projects. Independent producers can take deductions for tangible and intangible drilling costs in the current year. Whatever you spend on drilling can be tax deductible. Independent producers can also deduct depletion at the rate of the 15% of gross revenue. The beauty here is that the depletion deductions can be greater than the amount that you've invested. If you hit a well that produces more than anticipated, you could have tax write-offs greater than the amount of you invested, and you'd be earning the revenues from that oil production. These intangible drilling cost credits and depletion deductions are not available to the large integrated oil companies. The tax incentives for oil and gas fossil fuels were largely maintained in the new 2025 tax law, while many incentives for solar, wind, and other renewable and energy efficient technologies were reduced or curtailed. The new 2025 tax law permanently extended the benefits of investing in qualified opportunity zones, which were previously scheduled to expire at the end of 2026. Qualified opportunity zones are specific census tracts in the US that are determined to have lower GDP growth or lower GDP per capita. Opportunity zones are designed to increase capital expenditures in those economically depressed areas. We typically think of opportunity zones in terms of real estate, but it also qualifies for oil and gas and private equity investments. Investors in opportunity zones can defer capital gains from previously exited investments for 5 years, while investments in opportunity zones are not taxed when they're held for 30 years. Energy markets are a key point of contention in the ESG discussion. Should electricity be generated by wind and solar or by fossil fuels, such as oil, gas, and coal? Environmental, social, and governance issues are one of the toughest debates among investors. Many investors, especially university endowments and pension funds, have divested from coal and fossil fuel investments. In fact, some banks have stopped financing fossil fuel projects. You might think that this industry is being starved of capital, and that would reduce their ability to produce and what some people would say their ability to pollute. However, there's a continued necessity for producing oil and gas and coal because we can't meet today's global energy demands without fossil fuel investments and fossil fuel production. There continues to be a demand for fossil fuel products, whether people want to invest in them or not. In 2023, over 59% of US electricity generation came from coal, oil, and gas. At the same time, electric vehicle sales were 14% of global new car sales. The majority of global electricity production is still sourced from oil, gas, and coal. It may take many decades to flip that switch to where there's no demand for oil, gas, and coal. What's the result of this divestment? If the pension fund or the university endowment sells its Exxon stock to another investor, there's zero impact on the amount of capital available to Exxon. It's an underappreciated fact that if you're selling your publicly traded stock, you're not starving these companies of any amount of capital. But if new projects are less able to be financed and investors and lenders are leaving the sector, asset prices can decline. The oil majors such as ExxonMobil and Chevron are trading at maybe half the PE and twice the yield of the S&P 500. Many of these stocks have yields of 4% or higher with a PE of 15 times or less. Value investors might be attracted to the oil and gas opportunity, but they might be advised that there's political risk in doing so. Ironically, the oil majors are some of the largest investors in clean and renewable energy. That brings us to our last topic of the energy transition. It's interesting to know that there's a similar amount of new capital being invested in fossil fuels as is being invested in renewable energy projects. There's still new money being invested in both the energy transition as well as oil, gas, and coal. There's been growth in demand for global energy consumption over the last 20 to 30 years, with a 14% global increase in the demand for electricity over the last 10 years. And that's going to grow further for data centers and artificial intelligence. But there's been a substantial investment globally over the last 30 years in renewable energy production. There's more solar and wind capacity that's constantly being put online. In the 10 years ending 2002, there's a growth in electricity demand of 16% and a growth in renewable energy production of 23%. Whenever renewable energy production grows faster than the demand for electricity, the share of electricity produced using renewable resources is increasing. In the 10 years ending 2012, there was a 63% growth in renewable energy and a 25% growth in electricity demand. In the last 10 years, renewable energy has continued to accelerate with 79% growth relative to 14% growth in global electricity consumption. 39% of the world's total electricity is now being generated by renewable sources, including 12% in nuclear, 14% in hydro, and 13% in solar and wind combined. While the amount of electricity being generated by hydro and nuclear continues to be stable or declining, all of the growth in renewable generation is coming from wind and solar. Investing in wind and solar is not sufficient to meet all of our energy needs because sometimes the wind comes and sometimes the sun shines, and sometimes they do not. Solar panels generate a much greater output during the day and the summer and much less during the night and the winter. The electricity generated from wind and solar facilities is variable, so we will always need that base load, which comes from hydro or nuclear plants, which are relatively constant in their ability to generate electricity. If there's more demand than can be met by hydro and nuclear generation at a time when wind and solar are not producing, we will continue to have to turn to oil, gas, and coal to generate electricity. Even in 2023, after 30 years of investment, there's still only 39% of global electricity generated from these renewable sources, and it might take many decades before we reach that level. While the global level of renewables is 39%, that differs widely across countries. Some European countries like Sweden have as much as 69% of their electricity coming from renewable sources, while the US is stuck at 23%. There's still a substantial need for oil and gas-fired turbines in the US. There's a potential to reach very significant levels of renewable energy, as is shown by the Swedish example. Both Sweden and the US have had a declining share of their electricity being generated using nuclear. It's probably the same nuclear plants that have been producing for over 30 years, as new or expanded nuclear plants rarely come online. There's a constant amount of production of nuclear, but we're seeing a growth in renewable production coming from solar and wind. We've got a stable production of nuclear that's offset by a growing production in these other areas. Over the last 20 years, the US has reduced its use of oil and gas in the electricity mix from 71% down to 59%. Sweden has been successful in getting their fossil fuel consumption down to just 2% for electricity generation. It is possible to reach that renewable energy target, but it may take many decades for the US to get there. A key part of the demand for oil and gas is used to fuel internal combustion engines, the cars and trucks we all drive every day. While many people say that China hasn't reached their environmental goals, specifically because they still have substantial electricity generated from coal-fired power plants, China is by far the world's leader in electric vehicle sales, selling 8 million electric cars in 2023, while the rest of the world sold just 5.9 million electric vehicles. And electric vehicles are still just 14% of global car sales. The demand for electric vehicles may substantially change the commodity markets. Internal combustion engines or conventional cars use 22 kilograms of copper, 11 kilograms of manganese, and 9 kilograms of lead, creating substantial demand for these metals. But electric cars don't use any lead, which could lead to a substantial decline in the demand for lead if cars fueled by internal combustion engines cede the lead to electric cars. Conversely, electric cars use over 20 kilograms of lithium and cobalt per vehicle, making it important to ensure access to these rare earth metals. The demand for manganese, nickel, copper, and graphite is all substantially greater in electric vehicles than in internal combustion engines. As electric cars become more popular or more required by the regulators, this will increase the demand for copper, nickel, and graphite and decrease the demand for lead. There will be substantial changes in the commodity markets based on the type of cars that are being sold. Finally, from our friends at BNE, there are a wide variety of ways to play this energy transition. You could play it in e-mobility, energy storage, performance materials, energy distribution, and energy generation. It's not necessarily clear today which of these technologies would be demanded or even still be used 10, 20, or 30 years in the future. While some investment firms say you should invest in just uranium or just lithium, BME says that we don't necessarily know what the future holds. So it's better to invest in an energy transition theme in a diversified way. The key in many people's minds is the battery market or the energy storage market, because the difficulty of wind and solar is that you have to use the electricity at the minute it's generated. From 1 minute to the next, you could have a substantial change in the amount of electricity generated by wind turbines or solar panels. The clouds could come or go, the wind could stop or start, and you need to use that electricity the minute that it's generated, which is a challenging problem for the electric utility. But if and when battery technology progresses to the point where you could store all of the energy created by the wind and the sun in batteries and release it over time, now wind and solar become baseload power, and that makes much less of a need for coal-fired or oil and gas-fired electricity. That's our overview of the real asset market. The vast majority of the money invested in real assets is put into the infrastructure category, with oil and gas and renewable energy as the other key leading areas of investments. Some investors allocate simply through a futures-based commodity fund that invests relatively equally across the energy, metals, and food sectors. The reason why we might want to invest in infrastructure or oil and gas is that these investments have a similar risk of return to stock market indices while offering better defense against rising inflation. Real asset investments can be added to portfolios as a return-seeking asset on the order of equities, but it gives us a low correlation of returns to equities and to fixed income. The key is that traditional equity and fixed income investments tend to have a substantial downside risk during times of rising rates and rising inflation. Real asset investments, including infrastructure, farmland, timberland, real estate, and oil and gas, tend to offer higher returns during times of inflation. Not only are real asset and real estate returns competitive in the long run with equities, they also give us a degree of inflation protection and diversification that's not available in the equity markets.
Thank you again for joining us. We hope you enjoyed today's class. As a reminder, you can download your continuing education certificates of completion from the folders at the bottom of your screen. If you would like to continue the conversation with Morgan Stanley Investment Management to discuss any of the ideas covered in today's class, please click the meeting request button on your screen. Materials have been made available to download in the Documents folder at the bottom of the console, and we appreciate your feedback. So please take a moment to take our brief survey that is located on your screen. For additional insights, we invite you to register for upcoming classes at investinginalts.com. Thank you for your time, and we hope you have a great rest of your day.
All right, folks. So there you have it. As you can see, I'm not with Morgan Stanley at all, by the way, but I have these courses that I am with that I take because as your financial professional, people such as myself, as my brother Lux Privé Media, which I have him tagged in some of my my videos. If you want to go get, he's not an attorney, but he gives you a corporate compliance aspect of things. And I found that within my recent content, I'm doing a little bit of editing of videos because I need to let you folks realize that I'm not alone in this, right? I have people like Lux Privé, like Deontay Blade, who are down with what I do, and we're specialists in what we do. We're not some bullshit artist overnight. We're not some fucking uh, failed guy who left one of these big companies. Like I know a bunch of people with Primerica who left Morgan Stanley and they're saying certain stuff, and that allows me to know that they didn't get anywhere in Morgan Stanley. Right? You're looking at, highly liquid things like hedge funds, highly illiquid things like infrastructure. All this stuff is things that we have to go through this training to actually get, right? And I go through a lot of this training, and it's very difficult, especially when we look at oh, there's another one on March 10th I'm gonna go to direct lending. I'm gonna definitely do this. Let me register for this right now. Boom. And there's so many one second. Damn, I can't type right now. I registered for that one. Oh, I'm already registered for that. Good afternoon, Miss Phoenix. So again, I'm here. I'm not an affiliate of Morgan Stanley. I don't work for them. I don't sell for them. Now, I do have a relative who used to work for them, right? But if you'll notice, these are some of the classes that I've already signed up for. Because as a financial professional, I need to know a lot. Now, what you guys run into is people who may have a bunch of credentials but don't know a fucking thing, right? And there's a difference between getting the credentials and knowing things, right? Prime example. Let me turn off this camera real quick, and then I'm gonna get up out of here. Or turn on this camera. So you see stuff like this, the Series 65 exam manual. Now, I haven't passed this exam, but I have the manual. Now, I have some people who were trying to front on my RFC designation, Registered Financial Consultant from the IARFC. But there's a reason that there's a lot of people who are in the MDRT who have their RFC designation, right? Now, if we look at some other materials, right? We also have things like the SIE, right? Which I didn't take. We have the Series 63, the Series 6. Hold on. One that I probably prefer to get, which is this, the CRC, the Certified Retirement Counselor. This is 1, 2, 3, 4, 5 books. I took this test once. I did not pass it. Now, let me tell you, you have to remember 5 books of information. So there's a lot to be said about that there thing. But so people such as ourselves we're not your run of the mill guy, right? We're not, you know, just sitting here not knowing anything. At any rate, ladies and gentlemen, it's your boy, the insurance junkie, your fiduciary fellow, the all-star advisor Alonzo Hall, your social media insurance bro. And I've just shared with you some of the behind-the-scenes training that separates people like me, people like Lux Privé, from your average. Give me 1 second. My cat just lost his mind and jumped on the coffee table. But that's going to separate people like me, people like Lux Privé, from your average run-of-the-mill bullshit artist, especially a Primerican, who thinks that their Series 6 is an investment license and it's not, who thinks that a Series 65 is an investment license when it's not. It's an advisor's license. That's why you see it as a financial advisor, ER, with the hard ER at the end with the Series 65, because all you can get paid for is financial advice. You can't sell a security. Therefore, the only investment license is the Series 7. But people don't know that. We're not bullshit artists like your Wall Street trapper who tell you things like pips and dips and you can trade on blah, 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 because you are not licensed. See, you don't have the Series 3, the Series 4, the Series 7, the 34. You can't trade Forex, or FX is really what it's called, but Forex has been a heavily adopted term. That's foreign exchange, commodities, futures, right? They don't know about the PDT rule, pattern day trading. They just tell you, look at these candles, see, because we were up here and we were down there, because they know most people don't know what the fuck they're looking at. I had a gentleman who worked at my cousin's barbershop who was a day trader who was talking about he's got hundreds of thousands of dollars. So then when I told him to buy life insurance, he bought a $50 a month premium policy in his early 20s. That's what lets you know that motherfuckers don't know shit about Shaq. They be in real estate talking about they're a real estate investor and diminish cash value life insurance. That's stupid as fuck. That's like diminishing the Burr method. You wouldn't say, oh, well, this house has equity. That's trash. But you're going to say that about cash value life insurance, meaning you don't know what the fuck you're doing. And I wouldn't trust you as a real estate investor or a real estate agent. And guess what? A whole bunch of real estate agents don't know that shit. Ask me how I know. I'm going to show y'all something. Hold on. Because, see, I got to get going soon because I got to take my wife somewhere. But since we're looking at it, let's look at it. First, let's look at 899 Fulton Street. Let's do this here. Let's do this here. I gotta cook. And I ain't even mean to get so spirited, but the shit be getting to me sometimes. This is my first listing in New York City. This is when I worked at a real estate agency for a buddy of mine called the Encore Property Group. It was on 880 New Lots Ave in East New York, Brooklyn, New York. The first property I had was this, 899 to 907 Fulton Street, Brooklyn, New York, 11238, aka 486 to 490 Clinton Avenue. So this was near the Barclays Center, right? This was the first listing I had. It was 14.6 million. It just sold for about 7 million by Marcus Millichap, which is Goldman Sachs Real Estate. I'm going to show you all that too. But if you'll notice, here's my information. And this is an old PDF that I had set up, which is on read only. Let me make sure y'all can see this. Okay, y'all can see this. Let me shrink myself down here. Right? Now, if you'll notice, right here we got some of the scenarios, right? Located in Clinton Hill, on Clinton Avenue and Fulton Street. Had the block and lot, the zoning, right? The building size, right? 6,353 square feet. 5 commercial units on the ground level, monthly rent approximately $20,000 per month. The second floor is used as an office space by the landlord. All leases terminate in early 2017 or have cancellation on sale clause. All right, scenario 1, as is without development. 238,000 per square foot or of retail space. 3,176 square feet of office space. For a total income of 381,195. Your expenses were about 72,000. Half of that was reimbursed by the tenants. Water and sewer paid by the tenants. Electric paid by you. Insurance about 7,000 a month. Heat and hot water for the second floor about $1,655 paid by the tenants. Your total estimated expenses were $43,860. Your net operating income was $337,335, and your net value at a 4% cap rate was $8.43 million. Then you had air rights of residential, 1161 at $400 a square foot. Now let's look at the other scenario, retail and residential development, right? So we're just going to skip over the numbers really quickly. Asking price $14.6 million, right? So now let's just do this. 899 Fulton Street, Brooklyn, New York. Oh, they recently filed some permits. Okay. Let's go to Zillow. So now they're estimating it in 2026 off market for $2.295 million. Let's see, when did it last sell? Oh, they broke down the size. Okay. So first it sold in 2003 for $354,000. When I got it, I didn't sell it. But again, it's public record. In 2022, 20 years later after it first got purchased, it sold for $6.5 million. It's a 1,700% return on investment. Right? So let's see if I can show y'all one more thing. Because especially in our community, everybody wants to see shit. But they don't know what the fuck they see when they're looking at it. Right? So let me just share one more thing with y'all. So this here was an approval for a mortgage back in 2017, and my stepfather-in-law signed with us. But if you notice, that's for basically $1 million fucking dollars. In New York City, we couldn't really find a property for $1 million that fit what we were looking for. But the shit is there. So, ladies and gentlemen, I say all that to say, in fact, let me see. While I'm on the wait, let me drop the link because I want people to be able to come up and speak. Hold on. I'm going to drop this in the link. Why can't I? There we go. My computer is frozen. Hold on. There we go. Paste. Boom. So if anybody wants to come up, feel welcome to come up. I've just dropped the link in the chat. I do have to get going shortly because, like I said, I'm taking my wife somewhere. But I want us to actually have these conversations early and often, right? Because I just showed you approval for $1 million, but I couldn't fathom paying $60,000 a year in a mortgage. especially when it wasn't earning me anything. Right? And that's one of the things that I learned when buying real estate was have 4 doors before you buy yours. Right? So these are some of the important things that rubbed off on me early on, and I didn't want to get too heavy into it, but I definitely had to. Let me see. I got someone in the back. It says their device isn't connected. Once your device connects, I'll go ahead and add you. I can't add you right now. It won't let me pull you up onto the screen. Okay, here we go. Mr. Davidson, how are you, sir?
I am well. How are you?
I am doing outstanding. If you guys notice, you see that says President for America's Chamber of Business, right? Now, Rael, if you're in here as a black man, we already know about the NNBL, which then got co-opted and transferred into the Chamber of Commerce. So right here, we have another black man who is the president of a Chamber of Commerce, America's chamber, right? Not just local, nationwide. I'm sorry, I just needed to blaze you up a little bit there, Mr. Davidson.
Listen, I want to first and foremost say we appreciate what you do in the community. I share your content every opportunity I get because in a room full of noise, nonsense, and absolute misinformation, we need a beacon of guiding light to join this, I would say 1%, if less than 1%, who are delivering such exceptional value. I would definitely say less than 1%. And it is true. I am the president of America's Chamber for Business, Alan. My best friend is the executive vice president, and some of my other best friends are also executives and vice presidents. You see a theme there?
Mm-hmm.
We build connections in real life, as you alluded to in what you're saying, which is what brought us together. The many connections. Like what you're doing today, we need to keep doing that. I encourage it. And people need to be curious. Don't just listen to the noise. Don't, my CPA said this, my attorney said that. I'm sure they did. But when you're talking about building wealth, it is not for the faint of heart and is not for those. If you're just trading time for money, you most definitely need to tap in. We are talking about building something that will outlast you and your family members that you're never going to meet. And if that's the direction you're headed, we are your people. This thing that you're doing, Alonzo, it's absolutely amazing. 1000%. I cannot give you enough encouragement enough for what you're already doing. I was in my other group and I shared it because we have some other legacy builders, and I said, go ahead and tap in. It's free information. Told them who you were, sent the link. Those that can join, they will. And it's just a matter of keep bringing the awareness because we need it. We don't need hood dude with the tattoo. Not that there's anything wrong with tattoos, but get somebody with the actual credential. The RFC, that means something. Absolutely means something. And one of the things I love about you, you keep it real. You keep it real, you deliver the value, and people keep showing up for more, especially people like me, because I'm going to go into my network and say, hey, by the way, you need advice on that. Let me connect you with somebody who's actually doing that in real life. We're not talking about somebody who's working a 9 to 5. We're talking about a select group of professionals. What was that acronym you said? MD something or other?
MDRT, $1 Million Roundtable. I'll pull that up.
Would you mind telling your viewers what that actually is?
So the MDRT, which is the $1 Million Roundtable, is a. I'm going to pull it up actually as well. So it's a organization of the top 1% of financial professionals globally, right? And I'm going to pull this up here so that we can all see that. Are you guys seeing that on the screen?
We see it.
MDRT.org. So now watch this. Sign in. Let me just sign in.
Yeah, because I think like people have to understand like who they're in the room with. They're not having to pay you
Yeah.
thousands of dollars to actually listen to, whereas you've consulted with people and they've paid tens of thousands of dollars to hear even less than what you've already said.
Yeah. Now, as you see, there it has my photo, my Get Rich While Dying Trying. I need to update that photo. And I have 20 days left to re-register. So I got to do some ass kicking and get some commissions in. I'll be quite frank. It wasn't as good as I'd wanted it to be. And you have to continuously qualify. It's not just a one and done. Right? So they're putting me on the clock here. You got 20 days left, bro.
There you go.
Right? It's saying membership renewal. There goes my information. Right? Mr.
And for
Alonzo,
for all the viewers, again, go look it up. Alonzo is the real deal. You are not going to get this level of access, let alone somebody just giving it to you. Giving it to you for free. Everything that he just spoke about, you're talking about at least a 4-figure amount of value. And he provided it for free. What's
Can you
your
say that one more time? Because I don't think people understand what they're getting. And maybe that's partially my fault.
Well, so I'm not going to say that because I think a lot of times you deliver the professionalism and it's up to those that are actually listening to actually hear you. And that can actually work for you because it's a way to also filter out those that don't actually belong. So I would just say keep doing what you're doing because I'm going to be shouting it from the mountaintops. I'm not a registered investment advisor. And as you said earlier, I'm not an attorney, but you know, one thing I do very well, I read. And I read a lot. I read the things that matter to those CPAs, those attorneys, the advisors, and most importantly, to the client who needs those services. So before it even touches them, it's already been curated so that you're getting something that's actually workable and usable. Because at the end of the day, the only question that matters is it legal? Do I have the means to execute it? Simple as that. So when I want advice, guess who I'm going to call? Alonzo. Because he's actually licensed to do that.
I figured I'd just go to the IARFC as well.
Is your calendar? Can you also send me your calendar link so I can start sharing that too as well?
Yes, I'll send that to you via text.
Yeah, I got a guy looking at a couple options, and you are definitely the one to be able to help navigate that.
Absolutely. The only request I have is because we're both licensed that we work on it together.
Sure.
Because I appreciate taking referrals, but I prefer working with, if you're a credentialed individual, such as myself, I don't take your business from you, and you've already built that relationship, and that's worth something. I understand we've built a relationship, but I appreciate that you have that trust in me. But
1000%. It ain't even about the money. I go where somebody's doing their thing.
Yeah. But with that, I always, because I'm looking to build my network, and in building my net worth, it will building my network is important. So stuff like you and I's relationship is awesome, but I'm also like, listen, if there's something I have expertise in, and you're willing to send someone to me, and you're in this field, you're gonna learn it. Because what's only gonna happen is, what will happen is this: you'll go, hey, now that I've learned it, hey, Alonzo, let's work on this one together. And you'll just start bringing me stuff, and we're splitting it 50-50. Cool. But guess what? You'll start bringing me more stuff because you'll be like, I've got too much stuff to handle, and Alonzo can facilitate this, and I get half of that. Boom. And that's how I've grown my. So these are some of the things that we get with the IARFC, right? If you got, hold on, let me go to the consumers. Book, radio and podcast. So I've been invited by Dave Kinder who, so Dave Kinder and Moffitt. I don't know if you knew Moffitt was a part. He's not in RFC currently, but this is the Financial Advocacy Podcast, and I've been invited as a permanent co-host.
Nice.
So when they start back up, they're likely going to bring me up. And you see the credentials from Dave Kinder. Let's see if I can bring up his website. So my next thing is to get my MRFC, which is Master Registered Financial Consultant. Right. This is his blog, so on and so forth. I need to get the rest of this. I am also ethics approved. So not only did I get the RFC, but I got the ethics approved stamp somewhere. I don't know where I put it, but I have it somewhere. And ironically enough, as much as people try to diminish the IARFC, you actually have to follow fiduciary standards and to be part of that. Just like MDRT, like I said, I don't know if you were looking when I pulled it up. I was like,
I
shit,
was
I got
looking.
20 days.
Was definitely looking.
Yeah. And I'm like, shit, I got 20 days. And then they were like, oh, you need to give this, you need to give us that, and you need to find out how you're going to pay for it. So, you ready, babe? All right. So I'm going to get ready to close out. I definitely appreciate your vote of confidence, Mr. Davidson.
You have the entire chamber behind you.
Yeah. And, I
I
appreciate
mean
that.
that.
Oh, I realize that, definitely. And, like I said, I want to work with you guys because, I think the higher up you get in the income, the more it becomes about merit, right? When you're low income, you talk about people. When you're middle income, you talk about what people look like. And when you're high income, you talk about what people can do for what you're paying them for.
That's right.
And a lot of people confuse the high income or the what it is because you have upper middle class, and upper middle class is very similar to middle class. So they're like, oh, well, you have to have a suit and the shirt must be completely ironed. And I'm like, bro, I was on Wall Street with dudes who had a black card and millions of dollars. Their clothes were always wrinkled. You know why? Because the people who were paying them didn't give a fuck about what their shirt looked like. They cared about, are you going to make me X amount of $1 million? Right? You remember the rapper Baby? The not Baby or Little Baby, but the original Baby. So while I was at a stock brokerage called EJ Sterling, and I had saw a news article about the rapper Baby having his Maybach repossessed. And I was like, wow, you see, these rappers are broke. Well, just so happens that this guy by the name of Rob Costamiris, who was the CEO of the stock brokerage, had Baby as a client. He was like, man, I didn't know his net worth was that high after he hung up the phone. And he goes, I go, who? He goes, yeah, Baby, the rapper. I was like, oh, man, he's broke. He said, no, you don't understand. Rich people do that all the time. You're talking about the Maybach he got repoed? I said, yeah. He said, no, rich people do it all the time. He said, what ended up happening was he told them he wanted a specific color purple stitching. They sent it to him. It didn't have that specific purple stitching. He said, I'm not paying for this. Take it. And that was just funny to me. And so it wasn't that he couldn't afford the Maybach. It was that they didn't give him what he paid for. So
there's definitely a lesson in there.
Yeah.
Yeah, I know you got to run. Like I said, salute to you. Salute to your amazing work, your family. And we'll have a nice conversation offline because we got to connect on some other things. We got some other developments.
Yeah. So real quick, a young lady from Florida reached out, and we know her from the other app, TikTok. And she said she was going to hang her license with a certain company. And she was like, yeah, he told me no. And then I said, yeah, no. And then I told her, I was like, you know, they owe people lots of money. And, you know, from what I sent you, you know, and a couple of JEW lawyers in New York, they were like, bro, were you ready to get your money? So,
Hey, we
yeah.
are actively taking action, is what I will say.
Okay.
For those that know, they know, and and part of it's already gone public. But I will tell you, it didn't stop anything. If you're a Marvel fan, the best way I can relate is in the Thor Ragnarok movie, which is one of my favorite. You can't stop it.
Mm.
You can try, but it's gonna happen.
It's
So
gonna
remember when he
happen.
got his planet got destroyed because he was trying to stop it. But that
Mhm.
wasn't the real mission. The real mission was to realize that he was that thing. So no matter what, when you're doing what you're supposed to be doing and you're in alignment, the universe responds. You can call that what you want to, but we're getting results
Absolutely.
by doing the thinking, doing the research, taking the action. And then we get to do it with our friends.
Mm-hmm. So, all right, ladies and gentlemen, it's your boy, the insurance junkie, your fiduciary fella, the all-star advisor, Alonzo Hall, your social media insurance bro and registered financial consultant. And we just had a nice training session here. Mr. Davidson and I are probably going to be doing a lot more of these. I have a couple of
Now,
other.
there's no probably. We are. That's 100% facts.
We are going to be doing a lot more of these. I have a few other financial professionals who I want to bring along, and likely more to this platform than other platforms, because this platform is hard. And I like it because it's a difficult platform to get traction on. But when you get traction and those who actually rock with you, you get a lot less of those trolls, right? And you get a lot less noise. There's noise on this app, but the noise on this platform is a lot easier to cut through, because people have to be serious and you have to put out evergreen content versus buzzworthy stuff. So make sure you hit that like, drop a comment, subscribe, and hit that notification bell so you're made aware every time I release new content. And as always, share, share, share. Lastly, to contribute to channel growth or to schedule an appointment with a licensed financial professional for an evaluation of your own, the links are in the description. With that being said, ladies and gentlemen, wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. Wipe ass. Work in progress every day and see success. And remember, ladies and gentlemen, when people challenge you, they don't challenge you to challenge you, but they challenge you to challenge you. Accept the challenge.